Today we are going to talk about risk. So risk as it applies to bonds, stocks, real estate, gold, currency, the different types of risk that there are, the primary risks associated with the different asset classes, how you manage that risk, and how to kind of know where you may be sitting now. So let's just talk about risk right now in general. So market risk, okay? Just general market risk. That could be anything, a geopolitical event. It could be cash flow in and out of asset classes. It could, it can be anything, truth be told. It can be, the technology industry, some patent happens, who knows. General market risk. So the S&P rolls over, the NASDAQ rolls over. It's general market risk. That's the first type of risk. And how do you combat general market risk? You combat general market risk with knowledge. Because what has to happen before the general market can roll over is assets have to be sold off into the open market. That will be done by the guys on Wall Street. And how you can see what they're doing is through volume analysis. So you're living in the market's doing the same thing for the last 3 years, and all of a sudden, last month, you saw a huge increase in volume. What you know is that an event has taken place. If you're at a high, the event taking place is most likely selling. If you're at a low, the event taking place is most likely buying. So that's the best way that you can notice general market risk. And the one thing you don't want to do is you don't go against the market. I don't care what you own. There's no reason for it. When the general market rolls over, that means the market rolls over. So that's the first risk you're going to assess. Whether you're going in for long-term buying through your financial advisor, or whether you're trading, if the market is negative, now is not the time to be buying. It's pretty simple. If the market is positive and it's going up, well, what do we not do? We don't get in the way of bulls. So maybe you're buying, maybe it is a short-term buy because you're buying in the trail end of a bull market. But we don't get in the way of bulls, so we buy. If the market is rolled over, the market's negative, we don't catch falling knives. We wait for it to roll into a positive manner again, and we take advantage at that point. Next big risk. So obviously market risk is going to apply more. It's going to have a heavier influence on your equities, your real estate, things of that nature. Your next big risk is your interest rate risk. A lot of people talk about interest rate risk, but I don't think that anyone actually sits down and explains what interest rates do. So first, let's just talk about bonds. What do interest rates do to bonds? Well, if you own a bond right now and its par value, meaning what it's worth, is $100 and interest rates begin to increase, so you're getting 5% on this bond and rates are increasing to 7%, well, what the market does to make that bond still something that someone would buy is they drop the value of it. So now, say it's trading at $95. So you own the bond at $100, but it's trading at $95. The reason for that is interest rates have increased. So what we see there is that interest rates and bonds have an inverse relationship. If interest rates rise, you lose value in your portfolio. If interest rates drop, the value of your bond portfolio will rise. So when folks tell you that bonds are a buy and hold only, I mean, is that true? If you owned a bond and it had appreciated by 10% and you were getting 3% a year, not to sell that bond would be quite foolish. You have an appreciated asset. Interest rates, what else do they affect? Well, interest rates can dramatically affect the real estate market. Well, how do interest rates affect the real estate market? Well, if interest rates on a 30-year loan go from 4% to 6%, you can afford less house. So what do we mean by that? If you get a $400,000 loan at 4.25% for 30 years, let's say that you're paying roughly $2,300 a month. You take that 4.25% and raise it to around 6%, which, by the way, is the historical average for a 30-year mortgage is 6%. So if you're below that, you need to be listening. Or if you're thinking about purchasing, you need to listen. Because if it goes up to a 6%, your $2,300 mortgage is now $3,500. So if you own a home at $400,000 and your mortgage is $400,000, and all of a sudden the same people that were able to afford a $400,000 home are now only able to afford a $325,000 home, what do you think that does to the real estate market? It depreciates it. You can't have a bunch of homes that no one can buy. They can't be priced in a manner that no one can afford. So right now in the real estate market, that's probably your biggest headwind. Not to mention the fact that COVID-19, commercial real estate has really been hurt in certain areas. And, we don't know what the rebound of that's going to be. But interest rates right now are at historic lows. Interest rates have actually been at historic lows for 20 years. So I'm not the guy sitting in front of you telling you that that's going to change overnight. I'm not the guy telling you when that's going to change. What I am telling you is that if that were to change now, that's an incredible risk to real estate. So interest rates, they affect bonds. If interest rates rise, they affect bonds negatively and real estate negatively. If interest rates drop, they positively affect bonds, and I would say they should positively affect real estate. So that's something to be aware of. Let's talk about gold, the risk of gold. So oftentimes I hear that gold, you don't have to worry about gold. It doesn't drop. Gold's safe. It's a safe harbor. Gold is a gold bar. That's arguable. I'm not here to say one way or the other whether that's true. But gold is a commodity traded on the market. Gold in 1981 was trading at $1,000 an ounce. Take a look at the price of gold today. So if you hold gold for 30 years, you get to make, what? Where is it now? 30%? Over 30, so 1% a year? Not to mention that gold went from $1,000 and it dropped, I think, to around $475. Around 2002, 2003. So you would have lost half your money. So I do not view gold as a safe harbor. I don't think anyone should view gold as a safe harbor unless you're talking about gold bars. Same would go with any silver, platinum, any of those things. I'm not telling you that they're not safe if you own the actual precious metal. That argument could be made because you own a tangible product, and some say that anything tangible is worth more than anything intangible. And that I probably wouldn't agree with that, or I wouldn't disagree with that. I would say that's probably true. Owning physical gold, that's I don't think gold's ever going to go out of style, so probably not a bad move. Currencies have immeasurable risk. They have constant risk. So I'm not even going to get into currencies. If there's any currency traders on here, I can explain how currency trades. It works off of pips, not basis points. I can explain how fast it moves. The fact that you're margined 100 to 1 versus stocks where you can only margin 2 to 1. I'll have a conversation on margin in the future, not now. So currency, I stay away from. Other commodities, managed futures, for example, they have market risk and they have interest rate risk. The most important things that I think to remember about this conversation of risk is market risk is all encompassing. So market risk is going to affect bonds, stocks. Sometimes it does not affect gold, but it can affect gold and other commodities as well. Real estate will usually be subject to market risk. Interest rate risk, and I'm not talking about massive swings in interest rates where we're in an inflationary environment or a deflationary environment. I am talking about simple, typical interest rate moves. Risk is going to affect your real estate and your bonds the most. Market risk and company-specific risk will affect your stocks the most. And what you're always looking to do is you're looking to eliminate risk. And any good trade is going to have a 3 to 1 reward to risk ratio. So your reward should be 3, your risk being 1. We'll talk more about that in another video when we discuss more aspects of trading. But for now, I wanted to give you an idea about risk and where it applies and where it doesn't apply. Please consult your tax professional or your investment professional before taking any advice shown on this channel. This channel is for informational purposes only, and most of the information that lies within is based on my 20 years experience as a wealth manager. But please, again, consult your financial advisor, your CPA, before taking any advice given on this channel.